The Indian rupee has slipped to another record low against the US dollar, and this is driven by a toxic mix of surging crude oil prices, foreign investor exits and geopolitical tensions in West Asia, and of course the persistently strong US dollar. Analysts say the pressure is unlikely to ease immediately, although most still do not expect the rupee to breach that psychologically critical 100 rupees per dollar mark in the near term. So why exactly is the rupee falling? Well, oil shock is the biggest trigger. Remember, India imports anything between 85% to 88% of its crude oil requirement. The renewed escalation in the US-Iran conflict and instability around the Strait of Hormuz have seen Brent crude soaring well above $100 a barrel. Now that directly raises India's dollar demand for oil imports and widens India's current account deficit. Now, Reuters has reported that Brent crude has surged from roughly $70 a barrel to nearly $115 a barrel since tensions escalating. Now, according to analysts quoted by Reuters, every spike in crude worsens pressure on the Indian rupee because oil purchases are settled largely in US dollars. But oil is not the only thing. You also have foreign investors pulling their money out of the Indian market. Foreign portfolio investors have continued to sell Indian equities and debt, converting rupees into dollars before exiting. Now, the Reuters survey of currency analysts noted that capital outflows have crossed as much as $21 billion. Now, research platforms tracking the trend say cumulative FII outflows from India have crossed 3 lakh crore rupees in financial year 26, worsening dollar shortages and domestic forex market. Now then, there is the US itself as another reason. The US Federal Reserve's hawkish stance has kept US Treasury yields elevated, making dollar assets more attractive to global investors. Emerging market currencies, including the Indian rupee, have therefore weakened broadly as the US dollar gains strength. And then, of course, there is worry on India's current account deficit as well. The weaker rupee itself is not always a crisis signal, but economists worry because India's imports are rising much faster than India's exports. Higher oil and gold imports are widening India's current account deficit, which means India needs more foreign capital just to balance its external payments. Now remember, Prime Minister Narendra Modi himself appealed to citizens and businesses to conserve fuel and reduce unnecessary imports amid the oil spike, highlighting official concern over forex reserves and the current account deficit. So let's try and understand what exactly are analysts saying, and is there fear around the Indian rupee touching that 100 rupees per dollar mark? Well, in good news, some could say, a Reuters poll of 39 currency analysts found that the median forecast for the rupee is around 95 to the dollar over the next 12 months. Importantly, none of the analysts projected an immediate slide to 100 rupees per dollar, though risks remain skewed to the downside. Now, some institutions still expect recovery if oil prices cool and trade conditions improve. Bank of America, for instance, sees the rupee potentially recovering towards the 86 against the dollar if the crude stabilizes below $90 a barrel. ING, meanwhile, projects around 87 rupees against the dollar, assuming trade tensions ease later this year. But not all are positive on the Indian rupee. Now, analysts quoted by Financial Express and market researchers say a move to 100 rupees against the dollar would likely require crude oil above $130 a barrel. It would also require prolonged geopolitical conflict, continued FII outflows and a sharper global dollar rally. For now, most economists still see that a tail risk scenario rather than the base case. Now, the Reserve Bank of India has been intervening aggressively in forex markets by selling dollars through state-run banks to prevent disorderly depreciation. However, analysts also caution that defending the currency indefinitely becomes expensive for the central bank and for the country. Now, Reuters has noted that the RBI's forward dollar commitments have crossed $100 billion, even though headline forex reserves remain around $700 billion. So the question really is, what happens next? Well, the rupee's trajectory now depends overwhelmingly on three variables. First, of course, are crude oil prices, where every $10 rise in oil significantly worsens India's external balance. Then, of course, there is the West Asia tensions, where any escalation around the Strait of Hormuz could trigger another sharp sell-off. And finally, foreign capital flows. Now, if FIIs return to Indian equities and bond markets, pressure on the Indian rupee could ease fairly quickly. For now, analysts broadly expect the rupee to remain volatile and weak, with the 95 to 97 against the dollar range becoming the new near-term battleground. So despite Prime Minister Modi's austerity call, if you're thinking about a vacation abroad, setting aside a slightly higher forex budget may be wise.